Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to answer a question that someone had. He sent it to me on Twitter. I felt like answering it. I think it's going to be pretty valuable, at least to hear what my opinions are on this, to those that have this question. So let's dive into the question. Obviously, I'm going to give a bunch of my financial opinions on how I view the market, the paradigm of how I kind of view things. Am I going to be 100% right? I don't know. I mean, that's what we're going to go through. I'm going to show you the data. You guys can determine what you think is good or right or wrong, however you want to view this, and you guys can make up your own opinions. And I'm just going to connect the dots and show you the thought process that I have. So the question here, and it's on Twitter here. It says, "Hey Andy, huge fan of your channel. Although my main focus is on planning. You've sparked my interest in ratios, market conditions, and TA. I'm in a study group with several other certified financial planners, I'm guessing, and one offered this attached take on bond exchange traded funds versus treasuries in the current environment. Is there any technical analysis you can point me towards that supports what they are saying? Thanks in advance." So it says, "I so strongly believe in bond funds over anything guaranteed right now. History has shown that in every case that yields peak, bond funds outperform the top yields of CDs or treasuries. If they have time on their side, buy bond funds." So he is right if you know that yields have peaked. So what he is stating is 100% accurate. I completely and utterly agree with his statement here. But the question is, where are we in the cycle? And when he says history has shown that in every case that yields peak, the question is, have yields peaked? That is what you have to answer. Where exactly are we in this cycle? So I'm going to go over a little bit of information for you guys and describe a few things here. So this is the real estate cycle. This is what it is right here, all right? That's the real estate cycle. What happens through this cycle is you get a crash. This is your crash, and you go into recovery phase, you go into an expansionary phase, you go into a hyper supply phase, and then it crashes. This cycle is definitely different than other cycles. And really, when you look at this, you're supposed to be invested in certain assets as you go through this cycle. And that is where you gain the advantage. That is 100% where you gain the advantage, is knowing this cycle and where you're at in the cycle with a high degree of certainty. That is where all of the value is. And what I consider this, and what I call this, is market conditions. Ratios tell us information where we are on this curve. It can, to a certain degree. So all the data that I go over and all the technical analysis that we look at is evidence of where we are in this cycle. It is all interconnected. So where I think we are in this cycle is, I think we are just going into an expansionary phase of real estate. What Powell has done is he's raised rates dramatically to basically slow this down. I don't think he can stop it. I think he can slow it down, though. Definitely. So he's raising rates. He's bankrupting the country. We're still getting inflation and stimulative factors from that side of it, which is deficit spending. That's stimulative by nature. But I think we are somewhere in this range here. And why do I think that? What is the evidence? Why do I think that? And why is it so important? And I'm going to go and describe all of those things. I think that we're here because we have low inventory. And what we're seeing is that the sales, the percent of sales of homes, has dramatically increased for new home builds. The majority of sales coming out are new home sales against new homes. And people are going to give excuses. Oh, well, that's because they've bought down their interest rates. And they're going to give a bunch of excuses. Whatever, okay? There's not a lot of existing homes to buy. They're going to go buy a bunch of new homes. That is in itself inflationary. It also means that we are in an expansionary phase of real estate. We are seeing with evidence that the home builders are racking up decent sales and that the future for home sales of people in industry are still very positive on selling a lot more new homes in the future. That is why we're seeing some of these companies really start to rocket. So we're looking at Hovninian up 15.44%. This is one of the companies that we've owned on the channel from the bottom here. Boom, ripping it. Now, this thing's got a long way to go. This is the last bull market of homes. This, I think, will break out and we're going to go vertical again because we are underbuilt. This is evidence that we are underbuilt and that we are going to, I think, go into a very large expansionary phase of real estate. Why do I think that? Well, we can't go from the housing market, housing starts. We can't go from being in the largest deficit, which is down here, that area under the curve here. We've underbuilt the housing market. The estimates are somewhere around 6 million units that were underbuilt. Some instances they might say 3 million. Whatever it is, we're underbuilt. This is going to go into an expansionary phase, which we've done. An expansionary phase, by definition, is going over the average. So we're in that expansionary phase, and we've pulled back from interest rates. But I don't think we can stop this. I don't think we can stop it with interest rates. I think this is going to continue to move higher no matter what interest rates do. It's going to be fulfilled at some point in the future. If interest rates go way up, what's going to happen is they're going to crash the system and interest rates will fall back down. And this could fall back down, but we'll just go back up again. It's something that has to be balanced. The market is seeking balance that it doesn't have right now. That's why the inventory is so low, and that is why home sales are so high of new home builders. And that is why you're seeing all of the home builders put in long-term, ridiculous patterns where they're breaking these, they're coming up into a move here, and we've broken to the upside. This is one of the most bullish charts you can find, Leonard Corp. That is why Warren Buffett has recently purchased a bunch of new home builders. Buffett home builders. Warren Buffett bets big on home builders. He knows and understands the real estate cycle. Berkshire Hathaway invests combined $814 million across D.R. Horton, Lennar, and NVR. And they just so happen to have ridiculously awesome chart patterns. So he's out there, he's buying the crap out of home builders. What did he buy in oil? Well, oil, with Buffett, he's been buying the crap out of oil. Warren Buffett, 2023, we like Occidental's position. Why I'm still buying oil companies, April 2023. Buffett rules out acquisition. He's buying a bunch of Chevron, Occidental, all of these different oil companies. You know why? He knows the real estate cycle. So you're looking at all this, and all the home builders are basically crushing this thing, right? They're moving on up. What is the likelihood that Warren Buffett, one of the best investors of all time, is buying commodity companies, is buying home builders, and home builders are projecting greater sales, and that the real estate cycle that I'm talking about, that we're positioned right at the beginning of an expansionary phase of real estate? Well, that all lines up pretty dang good, in my opinion. So what that means is that interest rates are going to have to remain elevated for a period of time. That's why Powell always talks about an increased interest rate and why it needs to stay elevated for a long period of time. That is also another reason why interest rates have broken their long-term downtrend line, is because we've got this demographic that is buying a bunch of homes. And that's why we've busted on up. That is another sign that we're in an expansionary phase of real estate, but it also correlates to problems that the government may have with deficit spending and the interest payments as well. But this is a new era. Now, here's the tough part, okay? This is going to be a tough part, and I don't think anyone's going to know this, all right? Are we going to go higher here, or are we going to travel back and retest the breakout for yields? That has profound effects on the investments that everyone is in. As you can see here, we've come up, we've broken out, and are we going to come back down and do a retest here? It's possible. And I don't know if anyone knows that with 100% certainty. No one does. If we come on back, gold, silver are going to rocket. And bonds will go up dramatically as well if we were to come back down and loop back down here. And that is very much a possibility. But I don't think it will stay down there. I think what's going to happen is it would go down there temporarily. We would move on down temporarily, come back, make a return move, and then we're going to go back up again. Because the housing market's going to throw off a bunch of inflation if interest rates were to drop down like that with the deficit that we've got. Now, Warren Buffett is positioning himself in Homebuilders. He has insider information, guys. This is not a fair playing field. I have a feeling that he knows that something's going to occur. Either interest rates are going to be lowered or something on the lines of that Powell's probably going to do, and he's got insider information perhaps. If they lower rates or if they try to do something with QE or something like that, home builders are going to rocket. They're going to rocket, and they're going to fulfill that deficit in the market. And a lot of that's going to come is going to come from home builders. A lot of that. Now, if it doesn't go back down and we just keep going up, that still is going to be positive for home builders. Even though mortgage rates are going to be less affordable, we still have to, the market is still trying to find that balance. The only way that this is probably going to drop, in my opinion, is if we see a very large slowdown in economic growth, and he may pull it back. I don't know that. No one knows that information there. But every time that pulls back, bonds will go higher. That, by definition, this is bond prices going down, or bond prices going up, yields going down. And we're looking at yields here. So here's the difficult part here. That statement that you wrote here is 100% right. The problem is this could pull back in the short term because of economic weakness, but it's not being driven by the real estate market. So you have a lot less probability of success to know that pullback because it's only happened during the NASDAQ bubble. It hasn't happened in history since that, for most intensive purposes, since the 1970s. Every single time this has pulled back, it's been from a housing market crash or some other outside factor. We did get a pullback in 2019 where it pulled on back here, and it ended up being COVID. COVID accelerated this move down to the bottom of 2020. I would say that's an external factor, but they were raising interest rates and the market really started to puke on itself in late 2018. We could get another slowdown. It is possible that we come back down here. And the markets could shift lower, where bond prices do go up. And we are seeing signs of bonds getting traction down at this lower portion here. So this is the sell-off in bonds. It moves inverse to yields. We are getting that stability there. So, and it does look like it wants to go higher, which means bond prices could go higher and yields could go lower. So this would actually be an ideal entry point on a short-term move for bond prices. But, this is a big but here, okay? But I think a better bet would be gold and silver because gold also does well on a curve that when it uninverts, gold prices go up. So bond prices go up and gold prices go up similarly. You can see that, and I can show you a quadrant of this is basically traveling through the real estate cycle and where good investments are at. Gold and commodities do very well when you've got slowing growth. And that's where we're at. We're at slowing growth, but it's not coming from the housing market. We've got slowing economic growth to some extent. Not, I mean, it's slowing. Inflation is slowing too. So you're kind of coming back down this way, slowing inflation with I think maybe a little bit of slowing growth. So we might be coming back where gold and commodities do very well. And that is exactly where I think we're in the cycle, is where gold and commodities could do very well. But we don't have a market that is a free market. It is being managed. And every time we come back down with slowing inflation and slowing growth has been during a time where inventories of real estate has been increasing. Right now, we don't have that condition, which makes this the most unique cycle that we've ever seen in history. So I think that gold and commodities, they do well in both of these types of scenarios. But if you look, when you look at slowing growth and slowing inflation, that this is the other quadrant that he is talking about, that your friend. It's long duration treasuries and gold do very well under that market condition. So the safest bet under the market conditions that we have today is actually gold and silver and platinum. Those are the best. Now, I think that we are in this quadrant, somewhere in this quadrant up here, where growth is kind of going back and forth because they've jammed interest rates so high so quick that we're kind of entering this quadrant over here, where gold, commodities, emerging bond spreads, and inflation-protected bonds do well. But we do have slowing inflation. So they are right, but you need to nail where we are in this quadrant. You need to nail where we are in the real estate cycle. And where I think we're in the real estate cycle, we're still early. Buffett agrees with that. I agree with that. Zillow agrees with that. Now, there's a bunch of other people that disagree with that. They think that we are in the hypersupply phase, but we have no supply. So I think that they are all wrong, and I think that we are in an expansion phase. And I think that is, we're there by definition. We don't have a hypersupply of homes, by definition. So I think that we have a long way to go to build a lot more new homes, which will be inflationary. And the money is going to rotate in these types of areas up here, where gold and commodities are going to do very well, and that inflation is still going to be elevated. The bond market, you might be right with bonds in the very short term, but you won't be in the long term. The best play to play this with is gold and silver, bar none if you want the safest play. Physical gold and silver are the best plays in this type of condition. But then we can go back to the charts and we can say, okay, well, what does crude oil look like? What does it look like? And what we're looking at from a complex view is that crude oil looks absolutely fantastic, and that this is also another form of assurance of where we are in the real estate cycle. How do I know that? Why do I say that? Well, this here is a gigantic move upward that we've broken the consolidation zone in crude oil. Crude oil is an inflation-sensitive asset. We've got our pullback, and they did the SPR flood, which amplified this pullback. This is going to get everyone on the wrong side. They're going to all be off sides here. Then we have a breakout to the upside for crude oil in the short term here. We just broke out back in June, July. We broke out, and this looks good to continue higher in what is considered to be wave 3, the largest wave of the market. This is wave 1. This is wave 2, the pullback, and wave 3 is going to be a gigantic wave, given how big wave 1 is. Oil just broke out. We did a retest of this trend line here. This is a retest here. Technical analysis-wise, we're sitting on top of the pattern. This is ready to go higher. So oil is signaling that we have inflation, that money printing is occurring, that some stimulative factor is in the mix here. And if oil is going higher, it's also another function that we are in a stage that is up here somewhere. I don't know exactly which stage we're in. I think we're over here or over here. I think we're somewhere over here, but coming down this curve. So gold and commodities are, I think, the sweet spot, and they're both going to run. So what we saw historically here, and this is what I'm going to say here real quick. Gold and commodities is your wave 1 and potentially wave 3 of the move here. And the reason that I know that is because when we look at last bull market, this is wave 1 here, wave 2, wave 3, wave 4. This is in that right-hand quadrant here. The left-hand quadrant, when things slow down, is when inventories start to bulge. Inventories started to bulge in about 2005, 6, 7, like 6, 7, and 8 was where inventory really took off. And that's the last blow-off move is where you put you in the quadrant over here, which gold and commodities have blow-off top in commodities. Gold starts to run too, and that's when you want to load up in your long duration treasuries, is when this starts coming back down. You want to get into treasuries when this thing comes to the top here. That is where you want to take your profits in crude oil and dump them all into bonds here for the crash that ensues. So that is where you want to be, but they're early. The bond guys are early right now because we haven't taken off in wave 3 yet. And that is where Buffett is knowing where we're at. So we've done, if you were to look at this kind of overlaid, we've done this move, if we were to overlay it, and I got to get this all shrunken up here, guys. So if I were to overlay this, we've done basically this move here. That's the move we've done. And this is wave 1, wave 2, wave 3, wave 4, wave 5. And maybe it scales the same way. Maybe we don't get the blow off top like we had. I don't exactly know with 100% certainty. No one does. But that's the move here. You can even see how this overlays, and it's the accumulation here. This is your accumulation cylinder that you look at. You go up in a couple of waves, 1, 2, 3, 4, 5, 6, and then we go into that big blow off move to the upside. There it is, the big blow off move. We'll hit $290, maybe $300 or so is probably what we projected. $300 at the end of wave 3. What did they just come out with? $300 oil price projections, right? And people are starting to warm up. JP Morgan Chase, this is July 5th, $65 or $380. Analysts have wildly different outlooks for the oil prices in 2023. Here's what they expect. And we're starting to get more price predictions of oil that are much higher. Worst case, oil forecast up to $240 a barrel. Russia warns oil price $300 if West bans imports. There's a lot of things that are going. That is wave 3. I'm getting a price projection, if you overlay the fractal, of about $300. That's where they're getting that type of move. This is how it moves. This is how it aligns. And in order for this to occur, it almost always occurs under an expansionary phase of real estate. And guess what? We're in the expansionary phase of real estate. That's why Warren Buffett is loading up in real estate. That's where my thesis came from. That's why I'm still long oil, uranium, and all those things. Uranium is just starting to break out of its bottoming pattern. That is more evidence that we are early in this expansionary phase of real estate, that we're early in the inflation cycle, that interest rates can still go higher. So the thing here is, I strongly believe in bond funds over anything guaranteed right now. History has shown that in every case when yields peak. The problem is he or she does not know when yields peak. That is the problem. In my opinion, yields are not going to peak yet. I think that we have to build the homes, which is going to put pressure on yields to continue higher. Commodities breaking out like they have on URA here, that is going to be even more pressure for yields to go higher. If you look at how I've overlaid this fractal, I have that going all the way up here to about $66 in a heartbeat. And that's out 2026. We have a few years before I think yields are going to peak and crash. We may even be 3-4 years too early. I am loaded up to the gills in this stuff: uranium, oil, energy service companies. And if you were to look at those charts and interconnect all this, how the heck do we have an inverted shoulder head shoulder bottoming pattern in XOP if we are going to crash and move lower? There's no way, guys. In my opinion, we are going higher. We are in an expansionary phase that they can't stop because there's a deficit in the housing market, and that is typically when commodities run. Now there are people that have overlaid the real estate market with commodities, and they even have labeled. If you were to look here in an expansionary phase, let me see if I can find it. And I've seen some people label this where they label commodity boom during this time frame, which is exactly the right time frame to be buying commodities in. You can say real estate commodity cycle. I can't find it yet here, but we're in this, commodity to S&P 500 ratio. We're at this low that's going to cycle back up, and it cycles back up during that real estate market, and we are cycling back up. I mean, it is clear as day when you look at all of the evidence of a double bottom of commodities. Copper is going to go higher. They're all putting in bottoming patterns. So the question here is, where are we in the cycle, and how do we know with what degree of accuracy that we're in that area? The people that I talk to or that I follow and watch with 45 years of real estate experience, and they've seen many cycles, what they will tell you is you will not have a top in real estate if the inventory levels are low. You're going to see an increase of inventory levels probably towards 8 to 10 months. You're going to see prices start to decline and go on down. You're going to be building a bunch of new homes in an expansionary phase. You're going to come into a hyper supply phase of real estate. Home prices are going to go flat for 2 years. Then they're going to start to decline. Then you're on the backside. Commodities don't go down. They continue to go up because of the momentum in the system of that inflation that was generated from the real estate market. That momentum will carry you about 18 to 24 months. So when the generator stops generating inflation, which is your new home builds and the new loans that are going on into the system, it's going to continue to generate 18 to 24 months after the real estate market turns. We haven't seen a turn in the real estate market. We've seen prices in some areas, local areas, start to turn, yes. And they may have a wobble, so to speak. But we haven't built enough homes where all these millennials can go out there and buy them. And people are going to say the affordability isn't there. I think you are looking at it the wrong way. We are so short homes right now that we are at an affordability that no one can afford. We also had a large increase in interest rates. People are being priced out, just flat out being priced out, bar none. So people are being priced out. And this cycle, where we're at in the cycle, with the commodity guys all putting in these big bottoming patterns and breaking to the upside, still tells us that we're not late, that we're still early, that we still have at least a few years of moving higher before I think a market crash. That is why Powell is saying I need to raise rates and keep them higher for longer. That is why. It's all the charts are agreeing with this. They are all interconnected. That is why I also think that you could be right in the short term with buying bonds, but I don't know if you're going to be right in the 2, 3, 4 year time frame. But bonds have gotten destroyed. Yields could definitely fall in the short term. And the bond guys could definitely be right with long duration bonds. The markets could slow down, and it could be something that is external to the housing market, like the tech bust in 0102. We very well could get that. But looking at the charts, guys, there's no way I would be positioning in bonds at this current moment with the way that uranium looks like breaking out of those patterns to the upside, with oil breaking to the upside, with a lot of these commodities and the chart patterns exhibiting falling wedges and breaking to the upside. Silver looking absolutely fantastic. So when we transition from an inverted yield curve to an uninversion, so this is the curve that's inverted. Inversion goes down. When we go to uninvert the yield curve, I'm using the 30-year and 10-year here. That is when gold starts to accelerate to the upside. So gold, what you're going to see is gold loves it when the yield curve uninverts. It hates it when it inverts. Loves it when it uninverts. Hates it when it inverts. And then we are going to uninvert at some point. Now, could we stay low here? Yes, we could. And it could be delayed for a year or two even. But positioning in gold now with where the yield curve is inverted, I think is the best area to buy would be gold and silver, physical gold and silver, or these royalty companies that aren't pressured by inflation. If you look at the gold price here, we're sitting on top of a pattern, guys, and yields could go lower. That is a possibility. I'm not denying that. And commodities could slow down for a little bit, potentially. But we've got good chart patterns, and I have to go with how the chart patterns look. Gold could easily rocket here, and I think it will rocket. Silver is also looking fantastic, and we're right at the last kind of form of resistance. Long-term wise, we are going to go higher, guys. This is going to break out, and we are going to go much, much higher. And if you were to look at what I think could potentially come, I kind of grab this fractal here, overlay it on the current one, and I'm not even going to really change it much. That is your fractal right there, guys. And that's what's going to happen. It's going to blow up. And it's probably going to be even bigger than what I've got here. Yeah, I don't think it's going to stop at 50 bucks. I think we're going higher than that. But that's my opinions. And gold, and here's another thing. What do you think the chances are that crude oil is wrong? The crude oil market, multi-trillion-dollar market, that the housing market breaking to the upside, all those home builders breaking up. How is it that crude oil is going to be wrong? The home builders are going to be wrong. Gold and silver is going to be wrong. There's no way, guys. There's no way that all that is wrong. So what that's doing is it's giving us evidence that we are still early in the commodity bull market, and that we have not come back down in that growth phase, and that the real estate market is still early, not late. That we haven't entered the hypersupply phase because we don't have the inventory of homes. I think that we are still going into an expansionary phase of real estate. It's still going to last at least a few years longer. The markets are probably going to go, I'm going to say, let's say we peak in 2026 for the home builders. I think that we are going to go and extend into 2027, 2028 for the commodity markets. And silver and gold are all going to probably go up together. We could see some ridiculous pricing in oil and uranium and all these other ones. I think that we're starting the third leg in this, and I think it's going to last a year or two at least for the third leg. We may pause when the real estate market pauses 2026. I'm guessing late 2025, 2026, wherever it is. I don't know where it's going to go. We built a bunch of new homes. We pause up there. The markets get one last fifth leg blow off top, and the real estate market's going to be gaining inventory at that time, is my guess. Obviously, I don't have the real-time data. We're going to have to watch it as we go, but this is just a prediction. And that's when we're going to get the heck out of Dodge. Now, gold's going to do incredibly well under that market condition. The yield curve could stay low and be inverted for a while, a year or two, or whatever it's going to take. And then it starts to uninvert in 2025. It uninverts, comes on back. I'm just guessing here, guys. I could be completely wrong. Do not hold me to this prediction. I'm just throwing out things. It uninverts in 2025, and we get a crash in 2026, 2027, maybe 2028. I don't know how long we can hold this thing together. Another scenario is something external to the housing market slows us down in the short term. It pulls everything back for a period of time. Yields pull back, but the housing market just launches when they pull back yields. So we get a wobble, so to speak, or a dip. I'm not stating that dip is 100% in the bag. I don't know. No one knows. But the housing market isn't causing the dip immediately. So my thought process is to stay long. So what's going to happen is it's going to get everybody off sides if we get a dip in yields because everyone's going to run into bonds thinking a crash is going to occur. A crash could occur, but it's going to be like the 2000, 2001 crash, which is possible if it were to occur. The housing market's going to launch when they lower interest rates, inflation's going to come back, and commodities are just going to run like heck because they have to turn that credit spigot off and they're doing that credit spigot by interest rates. And if we get a slowdown, they're going to lower the rates, and that's when it's going to pop. But it's not going to be from the real estate market. It'll be from something else that I can't see. And that's no one's going to be able to see that. They're not going to put a thumb on it. Anything that's going to be well seen, I think, is already priced in the market. It's going to have to come from something that isn't seen. Now, one could say, when looking at this chart too, guys, that if I were to throw another one like this, that we're actually in a gigantic accumulation cylinder for silver. 1, 2, 3, 4, 5, 6, 7's the bottom here, and that we've kind of are doing our lead-in pattern, and then we're starting the big move here. What that means is that, and I think this is true, we also have another larger pattern that adds on to this. This is a cup and handle pattern. That if this is a lead-in pattern here where we've consolidated this, and that this is the lead-in, and then this goes, and that will go to some level that is far higher, to a land far, far, far away. And a reason why I'm so heavily invested in this. But that is a possibility. And I'm seeing accumulation patterns across the board in a bunch of different individual company names. They're all over the place. So people are accumulating. The smart money's accumulating it. And then we're going to get the big blow off top. All the people, the boys that chase the returns, the FOMO boys, they're all over in tech right now. That's all going to rotate into this stuff. We're not there yet. We're in the quiet accumulation phase in 2000, 2002, 2003. We've had a nice good pullback in 2020, and that's going to be the bottom of a lot of the commodity market. And people are quietly accumulating that in 2020, like myself and other people who've been around the markets for a little bit. Now, I don't know the future, guys. No one does. But that's my best guess. That's my best guess based off of all the current information that we have, based off all the technical charts, all the fundamentals that I know, based off of astute investors like Buffett loading up in the home builders, commodity stocks. He knows what's going on too. He did this back last commodity bull market. He bought PetroChina early in the bull market and made a buttload of money off of it. I think we're in the same exact location, like 02, 03, that we were today. It's somewhere in that range. Could we get a pullback? I'm going to leave it open to a maybe because I don't know if something in the market's going to yank things down. No one knows that. But my strategy is to stay long because the housing market is still strong. And I know people disagree with that. It's strong until the inventory goes way up. The homes are going to be built, guys. We have to go into a hypersupply phase at some point. So that's the whole gig there. The person's exactly right. The problem is the timing. I think they're early. I think that they're early. It doesn't mean in the short term, though, that we can't get that pullback. But no one's going to know that pullback. You're going to be guessing. If we had a hypersupply phase, if inventory was growing, then undoubtedly bonds are the best spot to be. When at that top, you're going to be swapping out of your commodities into the bond market, long duration bonds, 20-year TLT bonds at the top of the housing market, at the top of this ratio, commodity to stock ratio. And commodity stock ratio is still going up. We have a long way to go. And this is going to be a vast outperformance of commodities. That's some of the data. I can go to so many more charts, yields breaking, their downtrend lines, all of the different patterns, all of the different ratios, they all concur with what I'm saying. Platinum to gold ratio concurring, all of it. There isn't a single piece of data saying that this isn't going to occur that I can find. That is long-term driven, that would stop or prevent this from occurring altogether. The only thing they can do is delay it, in my opinion. They can delay it. They could shut things down and delay it further into the future. But if the homes aren't built, I don't know what they can do there. If people aren't pumping the oil out of the ground, if they're not keeping this all in balance, the debt in relationship to GDP, you're just going to get inflation. The money's going to still rotate. So that's my opinions there, guys. And if you like this type of analysis, I can go into the individual companies. Obviously, I showed one of them, Hovninian, which is a home builder that we talked about a little bit on the website. Now, I'm not big into home builders. I'm not. I think that the better play is commodities like uranium, oil, energy service. I think they're going to move as good or better. And some of these maybe royalty companies or maybe some miners might do some crazy stuff. We just got to break that downtrend of the XAU to gold ratio, which is also a signal that we are not in that phase of the market yet. Also another signal. They're all interlinked. It's telling us where we are in the cycle. We're still early in that expansionary phase. So that's my opinion. Give me a thumb for the content. If you guys disagree or agree, tell me in the comment section if you guys agree or disagree with this information. You guys can make your own opinions. That's the way that I view the markets and how I tie together all this information. So, yeah, again, we've got a discount for finding-value.com if you want to join our community. I go over individual companies. We are doing very well with the companies, I think. We're picking some really good ones. Some are still down. There are very good opportunities right now. And if you want to become a part of that, we have a 50% discount going on right now. September is the coupon code if you'd like to sign up. It's in the link below if you want to check out the website. And love to have you a part of the community. Come and ask your questions. Ask whatever you want. You can ask me anything. I'll give you an honest answer. I'm not. Honestly, guys, I mean, if you want to sign up, that's great. If you don't want to sign up, that's great too. I just want you to learn, get this information, make informed decisions on the market, realize that there's a cycle that's out there that you need to be aware of, and then taking that information and converting it into vehicles that will be successful for your investments. That's really the whole game. There's two main parts to this. The first part is getting the macro real estate cycle portion right and how to identify the correct market conditions for those investments and how to monitor it. That's step number one. Step number two is how do you play the cycle? What companies do you buy? What do you want to look for? What are the risks? That is the second part of it. The second part, you can nail the first part and get the second part wrong and still not make a lot of money in the commodity bull market or whatever bull market there is because you're choosing the wrong companies and the wrong vehicles. That is a huge problem. To be extremely successful, you have to get the right market conditions. You get the good entry points. You have to buy very early. You're buying patterns. You're not chasing price. You're buying patterns. And then you go in and you load up on what are very good risk reward companies. And it takes a special, it takes experience to kind of nail all that down. And there's a lot of companies that I throw out there that are in that really good risk reward camp to really benefit from the commodities bull market. Then there's companies that people they're going on the edge of the risk reward curve and they're trying to swing for the fence. You need to know when you're swinging for the fence. You need to know when you're not swinging for the fence. You need to know the companies that you should overweight in the portfolio and which ones you should underweight. You don't put a full weighting on. That's the whole point of becoming a better investor, is knowing that information. So, and obviously at some point I'm going to go over covered calls and how to generate income for your portfolio. And we can go over that. I can give you what I know about it, and we'll do that. So there's a lot of information that we'll be going over the next few months. And if you're interested, we've got a platinum question and answer session coming up at 7 a.m. Mountain Standard Time on Saturday. Show up there, ask your questions. Each one, you're going to learn more and more and more. And I'm here to teach you guys. I'm here to teach you what I see, how I'm doing it, and the approach and the strategies. That is how you'll be successful. Getting a stock pick and trying to ride it probably won't be successful. You need to learn it. And the strategies here are for long-term investments. They're not for short-term little market movements. We're going for multi-baggers, 5, 10, 20 bagger plus potential. That's a strategy. So that's what I've got for today, guys. I know it's a little bit longer clip. We'll end it there, and we'll catch you guys later. This is Finding Value.